Well, hello once again, and welcome to Tuesdays with Lloyd's. My name is Pat Talley, Regional Director and Managing Agent Practice Group Leader for Lloyd's in the U.S. Today, our focus will be on that most difficult of segments, U.S. property. With another hurricane season just around the corner and the other perils that inevitably accompany warmer weather, tornadoes, hail, wildfire come to mind, just to mention a few. The timing seemed appropriate for a discussion with experts on some of the key challenges facing the property market and whatever else might be on the horizon. So to help make sense of it all, we're very pleased to be joined by two individuals who deal with these issues each and every day. Ian Bridge, Deputy Active Underwriter with Dale Underwriting Partners, who manage Syndicate 1729 at Lloyd's, and Emma Watkins, Head of Exposure Management and Aggregation at Lloyd's. We'll drop a brief biography for each of them in the chat box for your convenience. And before we begin, just some quick housekeeping details. We strongly encourage you to submit questions for our guests, but please do use the Q&A tool instead of the chat box. It makes managing the questions process much easier on our end, and it ensures that we answer as many questions as possible. Today's session is being streamed live on Lloyd's YouTube channel and will also be recorded. We'll drop a link to the channel in the chat box, and we encourage you to share it with any colleagues and clients you think might have interest. There are now dozens and dozens of previous sessions available on the channel to conveniently allow for on-demand access. And with that, welcome to our guests, and let's just jump in. Ian, let's start with you. We've seen a protracted period of high inflation in the U.S., and I suppose for that matter, globally. How important is it in the underwriting, exposure and capital management process to ensure that inflation and therefore valuations are being fully and appropriately accounted for?
Yeah. Firstly, Pat, I'd like to thank you for having me on to speak today and extend a warm welcome to our US associates, many of whom I know well. Yeah, I mean, valuation, inflation is a question we get asked a lot from quite a lot of stakeholders, actually. So it's a very important topic, particularly given the levels of inflation that we're seeing globally at the moment, particularly in the US and UK. I think values really, in terms of an underwriting submission in property, are one of the most important pieces of information that we gather from clients, and that's usually the input that we use to calculate the price. Therefore, it follows that if the values are wrong, the price is wrong, and that's not a good thing for us, and certainly would present a challenge for us and in how we would explain that then to our own investors. The other points I'd make here is that we use these values to monitor our aggregate exposures, and you know these are then used to calculate our potential probabilistic and stochastic losses from vendor models. The output of these vendor models is then quite often used to calculate the reinsurance requirements of us as a syndicate, and also the capital requirements as well that we're then required to put up as FALB in Lloyd's. So therefore, you know, it then follows that if the values are wrong, the price is wrong, the expectancy of loss for cat losses is wrong, and the industry is potentially undercapitalized, and you know, and also less likely to meet profitability targets. So I've got to say to you, it's incredibly fundamental to the underwriting process for these valuations to be correct.
Ian, you mentioned one term there. I thought you said foul. How much? You want to maybe unpack that for some members of the audience who may not be familiar with that terminology?
Sure. Funds at Lloyd's is effectively the capital that we're required to put behind the syndicate, and is effectively the member that provides the underwriting capital to the syndicate.
Excellent, excellent. So do you find that being it's such an integral part of what you're doing, do you think that all clients are addressing the issue of high inflation, in their submissions to the market?
I think it's got a lot better. I think the whole process has got a lot better. I think, right through from in terms of the amount of work that clients are doing in the valuation gathering process, how they're being guided by the all of the brokers, that the US retailers, the wholesalers, and the London wholesale brokers who we then trade with on our business. I think everyone realizes that that in the past we've not been as good at it, but we have got a lot better. I think what we're seeing is some considerable increases in the values that clients are presenting us year on year, percentage increases, that is. And I think some of that is to address the higher levels of inflation that we're seeing, but I also think that some of it's to address undervaluation in the past.
Trying to bring things up to date, yes. Well, those are some excellent points from the underwriting perspective. Let's bounce over to Emma. From a Lloyd's oversight perspective, it'd be good to hear, Emma, your thoughts on Ian's comments and especially how Lloyd's views inflation and valuation and the role it plays in exposure and aggregation management.
Sure. And hi, Pat. Hi, everyone. Thanks for having me on here. I couldn't agree more with Ian's comments about how fundamental, and how important correct valuations are. They really play a vital role in understanding our exposure, in pricing it, in buying reinsurance for it, and in capitalizing for it. So it's huge, and there's been a lot of work going on here at the corporation for the last year on the topic. We have I think it's a weekly inflation working group, which pulls in members from our finance department, our reserving, our underwriting, exposure management, cat modeling, claims. It's a really big topic. And the way I see it is there's two sides to it. One is valuations. Yes, it's an added headache on top of the headache of ensuring we're insuring to value, and syndicates are putting in a lot of effort and deploying quite a lot of resources to ensure that they do have good valuation, good exposure data coming in from clients. Using all sorts of tools to benchmark the numbers that they're getting, to compare against previous years' data, to make sure that it looks like a reasonable uplift, and then to uplift that data if it appears it hasn't been accurately submitted by the client, then it will be uplifted before it's used in pricing and in exposure management and cat modeling. And that's only kind of one side of the story with inflation as well. And the other thing we've been talking to syndicates about is how do they look at inflation going into the future? Because it's all very well having a great understanding of what our exposure and what our potential losses could be right now, but when we plan for a future year, and when we capitalize, when we set the capital requirements for syndicates for the coming year, so later this year we'll be setting the capital requirements for 2024, we need to have an understanding of what kind of claims we might be getting in 2024. So that then requires a second element of inflation, and and this to me is even trickier. It's forecasting. It's having a go at guessing what inflation might do next year. How much more might our claims cost in April 2024 versus the data and the losses we might have this month? So we spend a lot of time talking to syndicates, and we ask them questions and send them questionnaires, which I'm sure they love, so that they can explain to us how they have a go at forecasting for inflation and forecasting for what losses might look like in a year's time. And generally, we do expect there to be an allowance in the modelling for how much more expensive those claims could be than they would be if they happened today.
So there's always an element of, I guess, crystal ball gazing, trying to figure out what that might be, which is, I guess, somewhat akin to where's the stock market going to go. So I guess that's an inherent risk in what you're trying to come up with.
It's it's a whole added layer of uncertainty. You know, I mean, we live in uncertainty. It's what we do. We're crystal ball gazing as to whether there'll be a hurricane this September or not. And yes, we're going to try and crystal ball inflation as well. Hey, this is what we're supposed to be experts in.
Exactly right. Exactly right. You have to earn it. Well, that's excellent. Thank you both for. I think it really helps us set the stage for the next topic we were going to move into, and that would be profitability.
Yeah,
I think
sorry. Can I just
sure.
Can I just make one more point on just to kind of follow up on Emma's point there about crystal ball gazing? I mean, I think one of the things that the market's been looking to institute for the exact reason of you know the level of inflation that we're seeing is valuation clauses, and I know that this is a relatively emotive subject in the market, so I thought I'd kind of bring it up, and there may be some questions on this, I'm sure, from the broking fraternity, but I think that's what these valuation clauses really have been designed to do, is to take away some of the uncertainty to our capital of potential future inflation. I really don't think that these valuation clauses should be seen as a criticism of the valuation collection method from insureds, because, you know, we are looking to underwrite the insureds and the values up front. What we're then trying to do is protect ourselves from the uncertainty of very high inflation in the future, as Emma says.
Absolutely. These things aren't static. They're ever moving in real time, of course. So excellent follow-up point. So like we said, we wanted to touch on profitability. You know, I think everyone was very pleased to see that Lloyd's recently reported a positive combined ratio of, I think, 91.9 for 2022. But, you know, despite the favorable results, we keep hearing from insureds and brokers that, you know, they continue to see rates climb alongside the valuation increases that we just discussed. Ian, maybe help us sort of unpack what factors you think might account for this, and if we might expect that to continue.
Yeah, I think we're all pleased to see the Lloyd's result. I mean, you know, it's at 91.9, given what's going on in the market in 2022 was a very good result. I think what I would say to that is that that result represents the result of many business lines, and you know, Lloyd doesn't just write property. There's lots of other lines of business that's written to get to that result, and actually, if you start to really just kind of boil it down to the bit that we're interested in today, which is US property, there was some interesting figures that came out from Verisk the other day, which was that, you look at 22, the P&C industry lost nearly $27 billion. That's 6 times the amount that was lost in 2021, which is also a $3.8 billion loss. So, you know, I think my point there really is that we as a property industry, we're challenged by our investors to make sure that our business is profitable as part of the line. And obviously what we're doing, because it has catastrophe exposure, is a capital intensive business. That being that, you know, it requires more underwriting capital to write the business that we're writing, due to the aggregations that we are exposed to, and therefore you would expect the result to be better than that. And, you know, balanced against the volatility, the cat volatility that we take, we need to be producing a good return for our investors. And you know, given what's going on in the market, and I know that we're going to get into the reinsurance market later, but what we've seen is the input costs of our business, that is the cost of capital, go up significantly, and our potential to get to our target combined ratio that we would use in the business planning process, which incidentally is mostly before the hurricane season has finished at Lloyd's, requires us to put up rates, particularly for catastrophe business, but to get to a similar type combined ratio as per our plan, due to these input capital costs going up.
So it's a never-ending battle to reach equilibrium.
It is, and what we've seen is, and when I know we'll get into this later, but not just the frequency of cat losses, it's the severity of these cat losses and the issues that these cat losses have brought forth in terms of, I mean, it's a fair amount of the losses that we look at for cat losses these days are in dispute, and it would be much our preference to get these claim payments paid and move on, and but quite often we end up in situations that just cost us more money, frankly.
Sure. Never ending. Absolutely. Emma, anything you'd like to add to those comments from Lloyd's perspective?
I don't think so. I think Ian actually covered it really well. Yeah, it's all about the diversification of the book, and there are lots of different parts of the Lloyd's market, some of which are profitable and are charging adequate rates, and some of which are not currently priced adequately, and so need to see increases.
For a good collective result, absolutely.
Yeah.
So let's move on to something that Ian, you had touched on. It's a topic that we seem to hear more and more about over time, and that would be conditions within the reinsurance market and the corresponding overall cost of capital. Ian, can you maybe give us some detail about how the reinsurance market has changed and what impacts this can have potentially on profitability and the overall cost of capital going forward?
Sure. Well, I think firstly the comment I'd make is really what we're seeing here is the classic demand supply curve in operation, really, and what we've seen is supply in the reinsurance market go down considerably, and demand go up, mainly as a result of the conversations we were having earlier. Inflation and valuation has increased. And what we're seeing then is that means that essentially people are looking to buy more reinsurance and less reinsurance is available. So the classic demand supply curve is basically seeing that the pricing of that exposure is going up considerably. And I think if you then look at the reasons for that, a lot of the reasons come down to ultimately the profitability that these reinsurers have seen over the last few years as a result of as I said earlier, the frequency and severity of cat losses that they've experienced. And I think, again, I'm sure we'll get into this later, but not only have we seen very large losses from what we would call primary perils, we've also seen very, very large losses from secondary perils such as wildfires and now winter storms. And that market has reacted to these losses and this situation where they themselves have lost investors down to investor appetite, and therefore their supply is down. We've seen this particularly in the ILS market, where the amount of ILS reinsurance capital that's available has gone down significantly over the last few years.
It's interesting. I'm as we speak, I'm at a reinsurance conference, the IRUA, and I just left a panel that echoed those comments exactly. So I mean, it's just a coincidence, but it's falling into lockstep to see some of these drivers and the effect it is having. Emma, anything you'd like to ping on to that?
No, it's well, I'll say something, but I'm not sure I'm really adding anything. It really is supply and demand, and the perception of risk. So the perception of risk has increased, or the perception is that the risk is increasing, and therefore the return that capital providers require on that risk is higher, and the return they require for their capital is higher, and that is making supply shrink, demand grow, prices go up.
Capital
yeah, I mean, for us, I'm not going to give too much away here about our own reinsurance renewal, but essentially it was the the triple whammy, if you like, of where we saw a significant price increase, as we've been alluding to. What we also saw were terms and conditions cut in. By that, what I mean is the perils that we could then recover from our reinsurances were cut back. The territories that we could then recover from our reinsurances were reduced. And what we also saw, which was the third blow, if you like, was an significant increase in the retention, our own retention. So all of those things together contributed to a much higher cost of capital, because reinsurance is effectively a form of capital in our business, and in today's market we simply can't take those costs ourselves, and that's why we're passing them on in the form of rate increases.
Do you see that? I mean, how do you see that progressing, continuing for the next year, or is there, I mean, back to our crystal ball? I mean,
yeah, I don't see it changing in the near future, I think, is really what I would say to you. I mean, we've seen some reinsurance capacity come into the market, albeit I think it's fairly limited. We're still significantly down as to where we were a few years ago. So I see, I mean, really for us, and I think it just comes down to investor appetite for catastrophe business at the moment, really. And I think, given the amount and level of losses that they've seen, that the appetite for taking on more catastrophe exposure from people that invest in the industry has reduced significantly.
It's an interesting dynamic, I think. People will use the phrase, "Is this a new normal?" But I feel like the perception is that we are in a time of heightened risk, particularly from perils that we maybe don't regard as our peak perils, and those are the perils that often do produce smaller losses overall. But what reinsurers are doing is not writing layers as low down as they perhaps used to, and the retentions are going up, as Ian said, so that reinsurers are protected from some of those small losses. And so there are a lot more smaller losses at small return periods probably being taken net by insurers, while at the top end of reinsurance programs, protection for the really big single storm, the 1 in 200, or something like that, the protection is still there. It costs more. But really, what we're seeing is a huge increase in the retentions at the bottom. And as Ian said, particularly for non-peak perils, where previously an insurer might have been able to buy some low down reinsurance against what we call rest of world perils, whereas now their retention is perhaps at one level, and it's the same level retention for US wind, quake, and all perils.
So a lot more churn and cost in the lower levels than previously. So
yeah.
Okay. Well, now we're going to stay on point. We're going to pivot to I think probably a favorite topic that I'm sure the audience will be very interested in, and that I know you'll both have some great perspectives on. That would be cat appetite. And of course, we can't really have a discussion on that without digging into cat losses. We'll bring that in next after we start. So Ian, let's start again with you from the commercial and underwriting perspective. Then we'll follow up with Emma to get her view from the oversight angle. What are the main factors impacting cat appetite, or perhaps maybe it's just the one factor that you think is driving things?
Yeah, I think that the one that I would definitely point to, and I suppose this is particularly relevant for myself, is that as Dell Underwriting Partners, we're a third party capital syndicate. That is, we rely on. We don't have aligned capital. We rely on getting third party capital to back the syndicate, and therefore we get to hear the views of a number of different types of investor into Lloyd's, and I think in every investor meeting that I've sat in, the appetite to grow their catastrophe exposure just isn't there, frankly. And what we've been tasked to do generally is try to keep the catastrophe exposures at a similar level across what is a growing business, so we can grow our catastrophe exposures, but only in line with the growth of the syndicate. And that that generally seems to be the appetite of most of the investors that invest in our business. And I think certainly what they've seen over the last few years is hugely volatile results, and that those results have been volatile mainly as a result of the cat experience that we've seen. And I think what the investors are looking for is much less volatile earnings going forward, so effectively trying to take less catastrophe exposure overall on the businesses that they invest in. And I would say really that is the major factor that's driving it. And that's why we see less capital in the industry that's prepared to support catastrophe exposure. I think that there's certainly in the meetings that I've been in there, investors are fed up with insurers saying that we're hoping that there aren't any cat losses this year, and if there aren't any cat losses, we're hoping to make a really big profit, because that just hasn't happened. And I think what they're charging us to do is make sure that the pricing adequately reflects the exposure that we're taking on, so that when there are the inevitable cat losses, that we don't have to come to them and say, well, the worst thing that you've made a loss, and then the second worst thing that it's impacted significantly your profitability, which seems to have happened in every year over the last few years. And I'd say that definitely fed up of hearing that as an excuse.
Yeah, I think it might even sometimes be a stretch to call the results volatile, because volatile results maybe suggest that some more years we might make a profit rather than making a loss. But actually it's more like the results have been consistently bad. I know when I started out in the industry, the expectation was that if you wrote a catastrophe treaty reinsurance book of business, you would have no losses for 9 years out of 10, and then maybe you'd have a really bad year, but you'd have those years of profitability then to pay for the losses that would come. We just haven't seen that in recent years. We've just seen cat loss after cat loss after cat loss.
Sure.
And that it all comes down to the appetite of the capital providers for that kind of risk. And if they're not getting the return that they want for that level of risk, and they're just seeing loss after loss, then their appetite for that sort of risk is diminished.
It seems like we're hearing a common theme here that, from my basic economics classes, it's capital. It always seeks a return. So if it's, we're seeing more evidence that there's stress on it from earning an adequate return in this industry. So it just picks up, takes its ball and goes elsewhere. Disintermediation, whatever you want to call it. I mean, is that a fair statement?
I think it probably is. Yeah. I think that's. I mean, that's what I would do if I had a lot of money to invest.
Yeah, well,
I think it's a good point, Pat, because obviously what we're seeing at the moment is a period of high interest rates as well. So what our return is being compared against is a risk-free rate that's a lot higher. And why would you put your money in a business where you have a chance of having a significant loss versus putting your money elsewhere and getting a decent return, not having to take a huge amount of risk? And that's the challenge that we have to deal with. And that's why we've got to start producing a consistent good return for our investors.
Yeah, and again, from a personal experience standpoint, it looked like, I know in the US anyway, where you have, the yield curve is classically inverted. So you see investors thinking, well, interest rates are effectively zero. Well, now short money, 3 months, 6 months is north of 4%. So you're seeing these other, heretofore options that were not there. So I think that just puts additional pressure to earn if you're looking for an ROI of 8, 12, whatever your bogey is. I mean, there are some competing things out there that are changing in the economic landscape.
Yeah.
Well, I think we've covered our main topics, and I think we have some questions queuing up. So maybe we'll take a stab at some of those. Let's see what we've got in the queue here. I'll throw these out, and if you want to take a stab, if not, we'll pass, but we'll see what happens. Here's one that's what is the expectation of admitted market contraction, say in states like Florida, to shift and accelerate growth to non-admitted surplus?
Yeah, I'll have a go at that one, Pat. I think it's a really good question. I think what we've seen in Florida is they've made some really positive changes in terms of the way the legislation works in Florida. And I think what we need to see is more positive change. Really, I think if you're an admitted insurer in Florida, there needs to be more legislative change. I think there are a couple of other things that are on the agenda as well to look at in that state. And then I suppose really the appetite's going to come down to how much the regulator allows the rates to change, because what we're seeing for Florida admitted companies is a huge increase in reinsurance costs, and they're going to have to be able to pass that on to their customers. They won't be able to take that to their bottom line. And if they're not able to change rates in adequately, then I would see that market contracting and more business going to surplus lines.
Okay. In fact, as again reference to the panels that I just came up from listening to, I heard a shocking statistic, and I'm going from memory, that Florida has approximately 6.5% of the U.S. population, but more than 70% of insurance-related litigation. So I thought that was quite telling. That's the one thing I wrote down in my last session in terms of a note. Let's run another question here. Second question: how much retro coverage is available these days?
Yeah, I mean that's a difficult one to answer. That Pat, to be honest. I mean, I think there's various reports that you can read that the large three brokers who place most of the reinsurance in the market put out. I mean, it's gone down significantly. It's not a question I know the answer to, I'm afraid.
Okay, excellent. Let's see, we're just running through the last couple here.
I think there's a good one on valuations there,
yes.
Pat, if you wouldn't mind. I think that. Yeah. So I just feel like that's a really good question, and so the question is on top of valuations, what proportion of claims in recent underwriting years have been subject to average clause and co-insurance? And I'd say very, very little, actually. And the reason it's very little is that we haven't been using average clauses or values limitation clauses as much in the past, and now what we're seeing is that as a reaction to the claims levels we're seeing, and I think one of the good things that we have these days is access to good information. So what we're able to do is cross-reference claims data with what the underwriting data that we receive. So, for example, if we're asked to replace a whole building, we obviously have access to the information of how much that costs. What we then do is cross-reference that with the values that we're being given by insureds, and I think that really has led to us challenging a number of insured values and valuation methodologies. I think what we will see as we're starting to use these clauses more often is that you will see these feature in as a part of the negotiation in claims. Yes, but good question.
Ian, there are two. Let's see. I think one more there, or two more. Do you want to take a stab at either one of those? Do you see them on your screen?
Yeah, I do. Yeah, I think, I mean, the question there is will underwriters in Lloyd's be writing more on a net basis, or reliance on retro is forever entwined? I think I would say that, yes, we have a reliance on reinsurance in most of the business we write. That is, I'll probably let Emma maybe expand on how Lloyd's looks at the how the syndicate nets down. But I mean, the real question on the net is that we are writing more on a net basis because our retention has gone up significantly, and that's really what I was talking about in how that factors into our cost of capital. So the answer is yes, we are writing more on a net basis, but yes, we are fairly reliant on finding a reinsurance solution.
Yeah, I would agree with that. It's kind of yes and yes. I think there will always be reinsurance and retro involved. I think that the cost of capital and actual capital is such that you would need so much capital to support the size of some businesses if they weren't buying any reinsurance or retro. That just wouldn't be viable. But we go through cycles. We've seen the reliance on reinsurance and retro increase over recent years, and yes, we're seeing it go down a little at the moment. I wouldn't be surprised if one day it cycled back up again. And we also have, Lloyd's as a corporation, we place some limits on how much syndicates can rely on reinsurance and retro, and we do expect syndicates to be writing a certain proportion of their risk on a net basis anyway, so that they have skin in the game. But it'll always be there. It'll always be a relationship that goes up and down. Do you want to answer the grey question here, the grey hair question, Ian?
Is that mandatory? I love that. We might have, I'm looking at the clock, and we probably have time for one more question. Ian, do you want to do any of those strike you as particularly compelling that are in the box?
Yeah, I think the one, what do syndicates look for in a cover holder as it relates to your topics? I think it's a very good question. I mean, I think what we're looking for there really is for our cover holders to learn the lessons that we've learned over the last few years, particularly, and valuation is making sure that they have access to valuation tools, and making sure that they look at their own portfolios and try to make sure that the values are accurately reflected, and that they move on sufficiently on a year-on-year basis. And that's one thing. I think the other thing is that we can learn as well together is that we want to try and cut down the severity of claims losses. There's not much we can do about the frequency, I'm afraid. That's slightly out of our control, but there are things I think we can do about the severity, in terms of making sure that our form and our coverage is clear, and try to avoid the additional costs of getting into disputes as a result of being more clear on coverage and what's expected, and making sure that we use these clauses that protect us in those instances as well. I mean, it's I think that's what I would answer in relation to these topics. There are a whole load of other requirements for Lloyd's cover holders, but yeah, in relation to those topics, those are important, and profitability, obviously.
Yeah. Absolutely. Okay, well, it looks like we've reached a pretty good stopping point, but I want to, if you have Emma or Ian, if you have any other final closing thoughts you'd like to make, certainly feel free to do that.
Not from me, but thanks very much, Pat, for your questions and your thoughts today, and thank you again for allowing us to speak.
Certainly.
Well, same from me, really. No particular closing thoughts, but thank you for the opportunity to be here and chip in on some of these topics.
Absolutely. Well, we want to express our sincere thanks for sharing your time and insight with us. It's certainly most appreciated. So thank you for that. And so that will do it for this month's edition of Tuesdays with Lloyd's. I hope everyone found the discussion informative and compelling. Be sure to mark your calendar for our next installment, which will be on May 16th, when we'll host the first syndicate showcase of 2023, and we will be profiling ASTA. ASTA is the leading third-party managing agent at Lloyd's. We've got some compelling topics in store for that conversation, so you won't want to miss it. And also, Mark, our man behind the curtain, will drop a list of our programs for the rest of the year in the chat box, so you can easily mark your calendars so you won't miss any of our monthly visits with Lloyd's. When our session ends in a second here, you'll receive a brief set of survey questions in your browser. Please do take a moment to fill them out and be completely candid in your comments. We appreciate that. We rely heavily on your feedback in building our content, so your support is most appreciated there. And you can also drop us a note anytime at usevents@lloyds.com. So until May 16th, let's keep staying connected. Take care and have a great rest of your day.